Alright, so you want to understand luxury betting, or at the very least you want to know what actually happens when you wire millions of dollars into a betting account and start placing wagers at the highest levels. First of all, a serious luxury betting operation can involve anywhere from $10 million, $50 million, to even $500 million in active positions. That's more than the annual revenue of most small businesses. It's more than the entire net worth of most wealthy individuals. But here's the strange part. The person placing the bet usually doesn't control the capital directly. And more importantly, how does betting millions of dollars actually make you money? Because in luxury betting, capital deployment is a completely different business than actual wagering, and it's far riskier than it looks. When people hear luxury betting, they imagine high-stakes poker games and exclusive casinos, but modern luxury betting is essentially a flying, self-sustaining financial operation. It consists of thousands of individual bets, sophisticated algorithms, and mathematical models welded and integrated into a system designed to withstand extreme market volatility and unexpected outcomes without catastrophic failure. Algorithmic trading systems capable of processing millions of data points per second, all built for an expected operational life of 5 to 10 years before technology becomes obsolete. Take a major betting syndicate operating from a financial hub like London, Singapore, or Dubai. But the capital requirements are not random. It all depends on the expected volatility of the markets you're betting on, the types of events you want to wager on, the data infrastructure you need to build, and the regulatory environment of the jurisdiction you're operating from. And then there's global sporting demand, the ultimate wild card that shapes everything. Betting market values don't behave like real estate. They behave like volatile stocks on steroids. When major sporting events approach and betting volume surges, betting syndicates expand positions dramatically. During off-seasons, they contract with staggering speed. For example, during the COVID-19 pandemic, when sporting events were canceled, some betting syndicates lost 60% of their capital in a single month. Betting positions worth $100 million became worth $40 million before the events even resumed, simply because demand had evaporated overnight. In luxury betting, there are three main players: the bookmakers, the bettors, and the financial institutions providing capital. And almost always they're completely separate entities with diverging interests. For example, a major betting syndicate might control $200 million in active positions. You see their names in betting circles, but they do not own all of that capital directly. In fact, many syndicates prefer to own as little as possible because capital ownership is a liability nightmare. Many positions are simply financed through debt and leverage from distant financial institutions you'll never meet. So who holds the capital that backs that $500 million betting operation? It might be a major betting syndicate like Bettors Trust or Syndicate Capital, which manages thousands of positions across their portfolio. It could be a wealthy individual from the Middle East or Asia who views betting as a long-term investment and status symbol. It might be a pension fund from Scandinavia or Japan, massive financial institutions that buy betting positions purely as diversification assets on their balance sheet. Or even a private equity firm operating out of a sleek office in New York or London. These capital providers don't care about individual bet outcomes. They don't care about specific sporting events or match results. They care about one thing: return on capital. Providing capital to betting operations is basically a massive high-stakes lending business. To make your money back, you have to charge interest rates that justify the staggering capital deployment and risk exposure. There are three main betting structures, each with a vastly different risk profile and return structure. Number one is the syndicate partnership, a safety bet for capital provider. The betting syndicate operates the positions and shares profits with capital providers at a fixed percentage, perhaps 40% of profits for 5 years. The capital provider provides the money, handles regulatory compliance, and carries insurance. The syndicate handles trading, data analysis, and position management. If returns are high when you invest, you lock in strong guaranteed returns. But if the market surges right after you invest, you're stuck at the old percentage. Number two is the performance-based arrangement. Capital provider funds the operation and receives returns based on actual performance. For the capital provider, this provides more upside if the syndicate performs exceptionally, but introduces significantly more uncertainty about actual return. The syndicate gets incentives to take excessive risks to maximize returns. Number three is the debt financing arrangement. The capital provider loans money to the syndicate at a fixed interest rate, perhaps 8 to 12% annually. For the capital provider, this is lower income, but also lower involvement and risk. For the syndicate, this is expensive, but offers maximum operational flexibility. This is where the system reveals its true nature with brutal clarity. When major sporting events are canceled or postponed, betting syndicates face an existential crisis. Demand for bets collapses overnight as events disappear from the calendar. Syndicates can't afford to keep positions open, burning money through operational costs while generating zero revenue. They desperately unwind positions, often breaking agreements with capital providers and paying penalties. Suddenly, capital providers found themselves holding worthless positions with no one to bet with. Positions that were generating $5 million per month in returns were now generating absolutely zero. Capital providers faced a difficult choice: accept pennies on the dollar to get their money back, or hold out and hope events resumed. Many chose wrong and went bankrupt themselves. The separation of capital provision and betting spreads risk, but it also creates contagion across the entire financial system. When betting syndicates fail, capital providers suffer catastrophic losses that cascade through their portfolios. How do these syndicates afford the operational capital in the first place? Because almost no one uses personal wealth alone. The typical financial structure is 20 to 30% equity and 70 to 80% debt financing. Financial institutions provide colossal loans, secured by the betting positions themselves as collateral. To protect themselves from catastrophic losses, syndicates use a legal shield called a special purpose vehicle. If a wealthy investor controls 50 betting syndicates, they do not own them under one massive corporate umbrella. Instead, they create 50 separate shell companies, often registered in tax havens like the Cayman Islands, Luxembourg, or Ireland. One company, one syndicate. Why? Because if a syndicate collapses or becomes worthless, the rest of the portfolio is protected from creditors. But there's a massive problem lurking here. Let's say you borrow $400 million to control $500 million in betting positions. A month later, the market crashes and the value of your positions drops to $200 million. You're now underwater on your loan. The collateral is worth less than the debt. The bank panics and demands cash immediately. If you can't pay, they seize your positions. Betting history is littered with the corpses of over-leveraged syndicates that made exactly this mistake. Let's assume you managed the debt perfectly and never faced a margin call. You still face another enemy that's far more insidious: regulations. A betting operation physically lasts 5 to 10 years before technology becomes obsolete, but regulatory rules are currently turning the industry upside down with alarming speed. The push to restrict gambling means sudden mandates for new compliance systems, responsible gambling measures, and tax increases, costing millions per operation. Furthermore, what happens if you build a betting operation today that operates in permissive jurisdictions to find out in 5 years that the global standard is strict regulation? Your operation becomes a stranded asset overnight. It's too expensive to operate, illegal in certain markets, and impossible to sell. Its $500 million drops to near zero. Syndicates are constantly gambling on regulatory trends, tax policies, and geopolitical shifts. Betting rewards patience and heavily punishes overconfidence. Because of this volatility, betting positions are traded just like volatile commodities on global markets. A major betting syndicate position worth $300 million might be worth $400 million in a boom, because demand for bets surges or drop to $100 million in a crash. Some syndicates don't even intend to operate for their full expected lifespan. They speculate relentlessly. Buy low, operate high, sell high, and when a betting operation finally reaches the end of its 10-year life, it still holds value. The data, algorithms, and customer relationships are sold to other syndicates or betting platforms. The owner is paid based on the residual value of the intellectual property and customer base, typically $5 to $10 million for a mature operation. It's a pittance compared to the original $500 million capital deployment, but it's better than nothing. The betting operation that once controlled hundreds of millions in positions is reduced to data and relationships. So why does this chaotic system work at all? For a betting syndicate, owning all capital directly is incredibly capital-intensive and debt-loaded. If global sporting demand slows down, a syndicate with $500 million in positions still has to pay interest on $400 million in debt, even if they're generating zero returns. Debt financing provides maximum flexibility. If demand drops, the syndicate simply reduces positions and pays down debt. The syndicate stays lean, the capital provider takes the financial hit. This separation of capital provision and betting spreads risk across the global financial system. When syndicates go bankrupt, the capital doesn't disappear. The capital providers simply take back their money and redeploy it to other syndicates. The companies may die, but the capital keeps flowing. The ecosystem adapts because capital is valuable regardless of who deploys it. But here's where it gets truly rigged and unfair to capital providers. Betting syndicates operate on razor-thin margins, typically 2 to 5% profit on capital deployed. Operational costs represent 20 to 35% of expenses. When technology costs spike, syndicates hemorrhage money and reduce positions. When costs crash, they profit and expand aggressively. But capital providers face a completely different problem. If technology costs spike, syndicates reduce operations and return capital. If technology costs crash, syndicates expand and demand more capital, driving up returns. Capital providers are constantly hedging against technology cost volatility, a variable completely outside their control. A sudden geopolitical crisis that disrupts sporting events can bankrupt both syndicates and capital providers simultaneously. The betting platform industry itself is rigged by design. Only a handful of companies control the major betting platforms: DraftKings, FanDuel, Bet365, and a few others. They control the entire customer base and data infrastructure completely. When you want to place major bets, you're not just placing wagers. You're entering a relationship with a platform that controls your access, your odds, and your ability to withdraw funds. Prices fluctuate based on demand, geopolitical events, and regulatory changes. You have no alternatives, no negotiating power, and you're locked into whatever terms the platforms dictate. During major sporting events, platforms that had accepted bets at certain odds suddenly found them unprofitable. They were forced to either accept massive losses or refuse to pay winners and face legal consequences. The platform duopoly means you have no escape. Behind every luxury bet is a complex web of financial players you'll never see or know about. There are betting syndicates that control hundreds of millions in positions. There are investment funds that buy betting positions as diversification. There are pension funds from Scandinavian countries that own betting operations as long-term assets. There are wealthy individuals from the Middle East and Asia who view betting as a status symbol and investment vehicle. There are even betting brokers who buy and sell positions like commodities, taking a cut on every transaction. This hidden financial ecosystem is worth hundreds of billions of dollars, yet it operates almost entirely outside public awareness and scrutiny. Betting operations are increasingly entangled with geopolitics in dangerous ways. When major sporting events are canceled due to political instability, betting syndicates face existential crises. Suddenly, positions worth billions of dollars become worthless. Their operators unable to recover them. When governments impose new gambling restrictions, betting operations can't access markets or customers. Betting becomes a weapon in geopolitical conflicts, and operators find their assets frozen or worthless. Geopolitical tensions can instantly destroy the value of betting portfolios, a risk that's impossible to fully hedge against. Operators are at the mercy of government decisions they can't control. The betting agreements themselves are masterpieces of financial engineering, designed to protect platforms at the expense of bettors. Platforms negotiate clauses that allow them to void bets if they become unprofitable. They negotiate terms that shift the burden of losses onto bettors. They negotiate residual value guarantees that protect them if betting markets collapse unexpectedly. Bettors accept these terms because they're betting on long-term appreciation and returns, but they're essentially betting against themselves. They're accepting downside risk in exchange for modest upside returns. Consider the economics of a typical betting operation carefully. A syndicate deploys $500 million with $100 million of equity and $400 million of debt financing. They operate betting positions generating $20 million per month in return. After 10 years, they've collected $2.4 billion in returns. They've paid off the $400 million loan, plus interest, roughly $600 million total. They've paid operational costs, technology upgrades, and regulatory compliance, roughly $800 million total. They've collected $2.4 billion in returns. Their net return is $2.4 billion minus $600 million minus $800 million equals $1 billion. They've made money, but wait. They still own the intellectual property and customer relationships. If they're worth $200 million at the end of the operation, they make $1.2 billion profit. If they're worth $50 million, they make $950 million profit. If they're worth zero, they make $1 billion profit. The entire return depends on the residual value of the operation at the end, a variable that depends on regulatory changes, technology shifts, and market conditions. It's a bet, not a sound investment. This is why betting syndicates are constantly monitoring market conditions, regulatory changes, and technology trends like hawks. They're not passive investors, they're active traders trying to time the market perfectly. Some syndicates buy positions at the bottom of a crash cycle, operate them, and sell them at the peak of a boom cycle, making generational wealth. Others buy at the peak, operate them, and watch the market crash, losing everything. The difference between success and bankruptcy is often just timing and luck. It's a casino for sophisticated players with billions at stake. The secondary market for betting positions is where the true desperation shows clearly. When a betting operation reaches 7 to 10 years old, it becomes harder to operate profitably because technology becomes obsolete and regulatory environments shift. Older operations are sold to smaller syndicates or platforms at steep discounts. A betting operation that once generated $20 million per month might be sold for $100 million to a smaller operator. The original owner takes a massive loss, but at least they get cash and eliminate the risk of the operation becoming completely worthless. The secondary market is a dumping ground for operations that syndicates can no longer profitably operate. And then there's the ultimate endgame, operation shutdown and asset liquidation. When a betting operation reaches the end of its 10-year life, it's shut down and its assets are liquidated. The intellectual property is sold to other syndicates, the customer relationships are transferred. The technology infrastructure is repurposed. The owner receives payment based on the residual value of the assets, typically $5 to $10 million for a mature operation. It's a pittance compared to the original $500 million deployment, but it's better than nothing. The betting operation that once controlled hundreds of millions in positions is reduced to data and relationships. The betting industry faces an existential transition that threatens operation values everywhere. Artificial intelligence, blockchain technology, and decentralized betting platforms are coming, but the timeline is profoundly uncertain. Betting syndicates are gambling on which technology will dominate markets. A syndicate that invests in AI-powered prediction models might find the technology delayed by a decade, leaving them with outdated systems. A syndicate that bets on traditional algorithms might find their approach rendered obsolete within 5 years. This technological uncertainty adds another layer of risk to an already precarious business. Operating a $500 million betting syndicate isn't just about managing debt and predicting market cycles. It means betting on the future of betting technology itself. Not all betting operations make it to their 10-year lifespan in active service. Some are retired early due to regulatory changes, technology obsolescence, or simply becoming unprofitable. These operations enter the secondary market, where they're sold at steep discounts to smaller syndicates or platforms. A major betting operation that once controlled $300 million might be converted to a smaller operation and run until it's literally falling apart. The secondary market is where operations go to die slowly, generating minimal returns for owners but keeping the asset from total loss. Eventually, even these operations reach the end of their lives and are liquidated for scrap value. Environmental and social regulations are reshaping the entire industry with unprecedented speed and severity. New mandates for responsible gambling, addiction prevention, and social impact assessments force expensive changes on operations. An operation designed for unrestricted betting might become illegal to operate if regulations shift. A platform certified for one region's market might be banned in another due to social responsibility regulations. Operators are constantly gambling on which regulations will stick, which will be delayed, and which will render their assets worthless. A $500 million operation can become a stranded asset overnight if regulations shift unexpectedly. The entire system is designed to extract value from bettors and transfer it to platforms and syndicates efficiently. Bettors get to place bets without owning operations, maintaining flexibility, and minimizing capital requirements. Platforms get guaranteed demand and long-term customer relationships. Banks get interest payments and collateral. Brokers get transaction fees on every deal. Betting syndicates get the residual returns in the hope that they timed the market correctly. It's a rigged game where the odds are stacked against bettors. Yet the system persists because it works for everyone except bettors. When a major betting syndicate goes bankrupt, it returns its capital to providers without hesitation. During the COVID-19 pandemic, betting syndicates like Bettors Trust and Syndicate Capital filed for bankruptcy. Suddenly, hundreds of millions in capital flooded back to providers who had no way to redeploy it. Capital sat idle in accounts, burning money through opportunity costs while generating zero returns. Providers faced a choice: accept pennies on the dollar to get their money back, or hold out and hope syndicates recovered. Many chose wrong and went bankrupt themselves. The separation of capital provision and betting spreads risk, but it also creates contagion. When syndicates fail, providers suffer catastrophic losses that ripple through their entire portfolios. Regulatory volatility is the invisible killer of betting syndicate profitability. Syndicates operate on razor-thin margins, typically 2 to 5% profit. Regulatory costs represent 20 to 35% of operating expenses. When regulations tighten, syndicates hemorrhage money and reduce operations aggressively. When regulations relax, they profit and expand. But capital providers face the inverse problem. If regulations tighten, syndicates reduce operations and return capital. If regulations relax, syndicates expand and demand more capital, driving up returns. Capital providers are constantly hedging against regulatory volatility, a variable completely outside their control. A sudden geopolitical crisis that triggers new gambling restrictions can bankrupt both syndicates and capital providers simultaneously. Consider the impact of a single regulatory event. When the UK tightened gambling regulations, betting syndicates faced losses. Capital providers faced reduced returns. When the US expanded sports betting legalization, syndicates faced increased competition and margin compression. Capital providers faced reduced returns. Every regulatory change sends shockwaves through the entire betting industry, hitting capital providers hardest because they have no control over operations. They just provide capital and hope the regulatory environment stays stable. Betting syndicates themselves are complex financial structures with their own risks. They manage billions of dollars in positions worth hundreds of billions of dollars. They finance this with debt markets. If debt becomes expensive, their returns shrink. If credit dries up during a financial crisis, they can't finance new positions. If their own credit rating drops, their cost of capital increases. Betting syndicates are exposed to financial market risks that have nothing to do with betting itself. Credit crisis in London or New York can bankrupt betting syndicates in Singapore. The concept of stranded assets haunts every betting syndicate. Technology changes, regulations shift, and suddenly an asset that was worth hundreds of millions becomes worthless. A betting operation optimized for traditional sports betting becomes obsolete as betting shifts to esports and virtual events. A syndicate designed for traditional algorithms becomes a liability if AI-powered prediction becomes mandatory. Syndicates are constantly making bets on technology adoption, regulatory directions, and market shifts. Wrong bets destroy wealth. Right bets create it. Some betting syndicates don't even intend to hold positions for their full lifespan. They speculate ruthlessly. Buy a betting operation during a downturn for $100 million, operate it, and sell it during a boom for $300 million. The difference minus financing costs is profit, but timing is everything. Buy at the peak and you're underwater immediately. Sell at the bottom and you lock in losses. It's a high-stakes game where milliseconds of timing can determine success or bankruptcy. Most speculative syndicates lose. A few win generational wealth. The secondary market for smaller betting operations is particularly volatile. As platforms consolidate in technology advances, older operations flood the secondary market. They're sold to smaller syndicates or platforms at steep discount. A 10-year-old betting operation that once controlled $200 million might be sold for $30 million to a smaller operator. The original owner takes a massive loss, but that operation still generates some returns before being liquidated. The secondary market extends the economic life of operations, but at deeply discounted rates. Betting syndicate financing is the lifeblood of betting operations, and it's incredibly complex. Financial institutions provide loans with complex covenants and restrictions. The loan amount depends on the operation's age, profitability, and earning potential. Interest rates depend on creditworthiness, market conditions, and regulatory forecasts. If the bank believes betting demand will decline, they demand higher interest rates. If they believe it will surge, they offer lower rate. Syndicates are gambling against banks on the direction of betting demand. Most syndicates guess wrong and overpay for financing. The insurance markets for betting operations are equally complex. An operation worth $500 million needs insurance against operational failures, regulatory penalties, and liability claim. Insurance premiums are based on the operation's age, compliance history, management experience, and market risk. Operating in developing countries with poor regulatory infrastructure costs more to insure. Operating in volatile markets costs more to insure. Insurance is another cost that directly impacts returns. Higher insurance costs mean lower profitability. Betting volume and utilization rates directly determine profitability. If an operation processes $100 million in bets per month, it generates more returns than if it processes $50 million per month. Platforms optimize marketing to maximize volume, but global demand fluctuates seasonally and cyclically. Major sporting events boom, off-seasons shrink, economic crises reduce betting, regulatory changes reduce betting, technology disruptions reduce betting. Volume rates swing wildly and betting syndicates suffer from low volume. An operation that should generate $20 million per month but only processes half volume generates just $10 million. The debt doesn't change. The entire system rewards platforms and syndicates while punishing capital providers. It's designed this way intentionally. Betting platforms want predictable demand and long customer relationships. Syndicates want flexibility and minimal capital ownership. Banks want collateral and interest payments. Everyone else absorbs the risk. Capital providers are the margin providers who enable the system to function. Without providers willing to deploy capital and accept the risk, syndicates would have to own everything and capital requirements would skyrocket. The system distributes risk in a way that incentivizes capital provision despite its precarious nature. If you want to understand modern betting empires, you have to understand capital deployment. You have to understand how wealthy families from the Middle East control 20% of the world's betting syndicates. You have to understand how European investment funds pool money from ordinary citizens to buy betting positions for returns. You have to understand how Asian syndicates use betting operations to generate returns. You have to understand that every luxury bet is ultimately backed by someone trying to generate returns by betting on regulatory changes, technology shifts, and market conditions. The system is rigged, but it's also efficient. It allows capital to flow to where it's most productive. The truth about luxury betting economics is far stranger than fiction. Thanks for watching. And if you found this analysis valuable, please subscribe to the channel and hit the notification bell so you never miss another deep dive into how global markets really work. The odds might be stacked against bettors, but understanding these hidden structures gives you an edge that most people will never have.